Hi, my name's Anna Serin, and I'm Director of Listings Development with the Canadian Securities Exchange. You're joining us for yet another market recap on Friday, December 17th. And I am, of course, joined by my wonderful co-host, Bruce Campbell with StoneCastle Investment Management. Thank you for joining me, Bruce.
Yeah, the last show of the year for us.
It is the last show of the year. I don't think we quite started in January of this past year. I think it might have been February, but we've almost done a full year. We've had some really good reception. I'm always happy to hear from people if there's certain things that you want to hear about, or if you want Bruce to explain and unwrap his amazing brain around the markets. Please contact us and let us know. This will be the last show for the year, and our next show will start back up on January 7th, 2022. So stay tuned. Don't miss us too much. There's lots to talk about today, Bruce. So let's jump right into it. We're going to talk about the Fed. There was some meetings. You're going to tell us what happened, what might not have happened. And in fact, today you are here joining us kind of as a guest host, because typically I speak with Jordan on Triple Witching Day. So Jordan is not joining us today, but we'll definitely make sure he's with us in the new year. We're going to talk about sentiment collapse, what that means and what to expect from that. We're going to talk about the Time named person of the year, if you haven't read this story yet, is none other than Elon Musk. We're going to talk about that. And then we're going to get into some information about gold, what's happening with them, and then, of course, some CSE issuer news. So let's jump into it. What happened with the Fed this week?
Yeah, it was a big week. The market has been waiting in anticipation of this happening. You know, the last time the Fed met, they talked about inflation and what that impact would have. This week when they met, it was quite dramatic. Obviously, everyone was in the investment business was literally sitting, watching, waiting for the announcements to come out. And what they decided is that they're going to double the rate of the taper. So that's the fixed income assets that they've been buying, and they're going to cut that back. They were at 15 billion cut back. Now they're going to go to 30 billion. So what it does is they're just like, going away from where they're going to be buying back any assets. And then the second thing that they did, which it was probably more dramatic for the market, was the fact that they, talked about that there would be 3 rate increases in 2022. And so if you look at the slide here, this is the famous Fed dot plots. And so each of the Fed members puts a dot where they see rates going in the future. And you can see kind of, where the dots are. They're all lined up in 2021 at, basically the same level. And then going out, you can see where they're increasing rates too. The expectation was that they would do 2 hikes in 2022, and they've decided they're going to do 3. The initial reaction from the market was good. The market had a great day on Wednesday when this was announced. Not so great yesterday. Came in this morning and it looked like the market was still a little bit angry. And now it's kind of mixed. There's some markets up, there's some markets down, but certainly not the same move that we saw yesterday.
Okay, so I love that the markets were angry. So just to clarify the first point, because we've talked about this before, when they say double their cutbacks, what that means is they will double the reduction of purchasing bonds. And really the point that the government will do this is to instill liquidity into the markets. Is that right?
They've been doing it to instill liquidity.
Right.
That started basically in March or April of 2020. And they are now at the point where they feel the economy is stable enough that they can start cutting that back. And so they're taking liquidity out of the market.
Right. Look at how much I'm learning from you. So this typically would be a sign of good things, because it means that they feel that the market is strong enough to carry its own weight and carry its own liquidity. Now, typically, do you see that happening at the same time that they announce a bunch of rate increases? Is that do they typically come hand in hand?
Well, they're, in the past, this whole bond buying, this is a phenomena over the last, 12 or 13 years now. It didn't really start till 2008. Prior to that, they hadn't really done that. Their monetary tools were really increasing interest rates.
Right.
And so we haven't really seen, I can't envision a situation where they'd be buying back bonds and increasing rates at the same time. So they'll be done the bond buying before they start increasing interest rates. And I can't remember what the projection is now, but they'll basically, I think it's to around the end of the first quarter, they'll be done all their bond buying. And then at that point in time, you'll start to see those rate increases coming. I think the first one they're projecting is in May.
Okay, so we have a bit of time. Okay, let's talk about triple witching. Now, normally, and this just happened by circumstance and then became on purpose, I have Jordan join me on triple witching day. I don't have the definition in front of me today, but for those of you that might not remember, triple witching is a day where essentially a bunch of things expire, right? Options expire, futures expire all at the same time. Is that right?
Correct. Yeah, that's exactly right. Yeah. And so typically we see, volatility around those dates. We see a lot of repositioning around those dates, both, to get in and to get out of positions. So, historically the triple witching day sees a bigger volume, but then the Monday following can see moves as well. And kind of coinciding with that is we're seeing, we've seen a fair bit of degrossing from hedge funds, which we've talked about in the past. So we're seeing a bit of everything here with that.
Okay, so what's hedge fund degrossing?
So with the hedge funds, most hedge funds have in their portfolios, which they refer to as a book, they have the long side, which is the stocks they like, and then they have the short side, which is the stocks that they think are going to go down. And so as opposed to most investors who are, if you have $1 million to invest, your $1 million is your portfolio value. Well, maybe they have $1 million to invest, but they're $1 million long and they could be, $500,000 short. So their gross exposure is actually $1.5 million to the market.
Right.
And so what happens is that coming into year end, especially when volatility picks up, you tend to see them shrink that down. So they'll be, maybe they're $1.5 million and now all of a sudden they take it down to $1 million, or maybe they go to 750 for their total investment. And so you see a lot of movement, volatility. What's happening is, they're selling their longs, which typically push those down, and then they're buying back their shorts, which can push them up, especially in, kind of more the crowded positions where there's a lot of overlap between different hedge funds. If they're all degrossing at the same time, then you end up with the longs going down and the shorts going up. And sometimes people, sort of scratch their head at what's going on and they can't figure it out because the stocks that typically have the worst qualities are the ones that are going up, and the ones that have been the strongest tend to go down. But that's just a function of what we're seeing. And it's a function of the end of the year. It's a function of, right, the increase in volatility that we've seen in the markets.
Interesting. Well, and typically we see the markets kind of slow down a little bit at this point. I do have to wonder what's going to happen, because I believe that, this new variant that's out there really is spreading quite quickly. And I think we're probably all need to stay at home. I wonder if people will be trading over Christmas. We'll wait and see what happens.
Yeah.
Okay, let's talk about the sentiment collapse. You talk a lot about investor sentiment, and this is obviously another part of that. So what's going on there?
Yeah, we've talked about it a lot on the show during the year, kind of both extremes for sentiment, when it gets pushed to an extreme on the optimistic side and when it gets pushed to a extreme on the pessimistic side. And we always look at it on a contrarian basis. So when it's really optimistic and everyone's, euphoric and they think it can only go higher, it typically means the last dollar has been invested in the market. And of course, it's not really the last dollar, but it's kind of that marginal dollar. And then, doesn't really surprise us that much when we see markets fall after we hit, sentiment highs. And then vice versa, when the sentiment pulls back the other way, it can, it show us that there's some type of opportunity. And so what we're looking at here in the chart is the North American Active Investment Managers Index. So they survey their membership to see how invested they are. So they can be anywhere from negative 100, which would mean they were short their whole portfolio, to long 100%, which would mean that they were long 100%. And then obviously zero is in between there. They actually can be long 200%, sorry. And so just recently, back in November, this got to a reading of 107, which is actually quite high. It meant that they were actually levered long. So they were borrowing money to invest on the long side. And now we've just seen a huge drop. This data lags a couple of weeks. So I know last week when we talked about the smart money index and what had happened with smart money versus dumb money and how that sentiment had gone to extremes. Well, now we're starting to see it with the active investment managers. And these are, historically, these are the portfolio managers in the US that manage money for individual clients. And so, they went from being really optimistic to really pessimistic. What we did here on the chart is we just put some lines for sort of similar times when it's dropped to extremes like we've seen now. And you can see that, it's been fairly good times to be a purchaser in the markets, because it means that things tend to get washed out. Obviously, there's always bigger extremes. So if you look on the on the left-hand side of the chart there, you can see when COVID originally hit and how it got washed to even lower extremes and what that meant for an opportunity. But, sort of just in general, normal market conditions, this is getting pretty washed out.
So that's pretty good recovery on the flip side of that, is what you're saying?
Yeah, I mean, it tends to be good times to buy, especially if you're a longer term investor and, you use any type of tools to try to time your buying and selling.
Yeah, absolutely. Okay, let's talk about the person of the year. So Time magazine comes out every year and it nominates a person of the year. This is causing a lot of controversy, that people have a lot of opinions about this one. And I think especially, I read a few articles on it. So Elon Musk was obviously named person of the year from Time magazine. I think the one thing that really kind of rubbed people the wrong way the most from what I saw about this was that we've had such an unbelievable, an unprecedented year in medicine, that perhaps there could have been somebody who, who's been out there helping us from a health perspective, as opposed to the richest man in the world. And he's just such a character, and there's lots of opinions around him. So tell us what's going on there.
Well, the thing that we like to follow with this is just, again, sort of the contrarian standpoint that, Time wants to sell magazines and they're going to do it any way they can. And so, they've obviously put someone whose stock price in Tesla has gone up, and done amazing things in the last, say, 24 months. And what we sort of have seen in history, and why we have just Jeff Bezos on there, is because back in 2000, he was the person of the year. And
I was going to say he looked so much younger there.
Yeah, his stock price at that time, Amazon was, hitting new highs. And then that was sort of the beginning of the tech wreck. And we saw, this big fall off in the price of Amazon. If you held it through that whole period, you would have done phenomenally well, because obviously we know what Amazon's done and what, where they've came from and what they are now as far as retail goes. Yeah. But we're just sort of comparing the fact that, like, when he was on the cover of Time, was when Amazon was peaking out. Is that, going to be a, sort of precursor to what could happen to Tesla stock this year? And so we found it kind of entertaining that, Musk was the person of the year after Tesla's had such a strong run.
Yeah, they've had a strong run. But he's an interesting character. I mean, he's under investigation. I know the SEC is all over him. There's a lot going on. I think, also he's just so vocal on Twitter. He has a good way of getting under people's skin as often as possible. So it'll be interesting to see what happens with that stock. Okay, what's going on with gold? I love talking about gold. I feel like we don't talk about gold enough. Tell us what's going on.
Well, interestingly enough, and again, this relates to sentiment, but when, gold tends to get sold off like it has now, and if you look at, kind of the worst performers of the year, gold miners would certainly rank up there beyond, sort of cannabis companies. Then gold probably ranks next as far as an asset class that hasn't, or a sector class that hasn't really done very well. And so the guys from Sentiment Trader put this together, and they actually took a look and said, when the percent of stocks over their 200-day moving average drops to where it is right now, what does forward returns look like? And you can see on the bottom portion of the chart, it talks about the returns, and you can see that, kind of the 2-week to 1 year time frame, the returns have been phenomenal. So, it might be the time that, kind of everyone looks at it from a contrarian standpoint, right? When, gold's so out of favor, the stocks aren't doing very well, that's the time to buy. And, we've been seeing more interest, and kind of that's upticked into the price of the commodity, where gold itself sold off. And then as the markets got a little bit more restless and uncertain here, the price of gold has been increasing, and it's now, right around that 1800 level.
Okay, I have a question for you. So, I mean, typically we see gold gold will develop strength in its price typically when there is a need for stability, right? And a need for safety. People will run to gold. But what are you seeing differently now that we're seeing kind of the massive influx in investment in cryptocurrencies? Because cryptocurrencies are not backed by an asset, unlike regular typical currency. So do you think that maybe gold will outperform as well because of people needing kind of that flip side of cryptocurrencies?
Certainly it should. Yeah. I mean, you look at, sort of historically, gold has been something that has been an anchor to a portfolio, especially when there's times of uncertainty. A lot of investors feel or felt that that was the case with Bitcoin, with other cryptocurrencies. But as you've seen, when the market volatility increased, those assets also sold off. So, they might not be that store of value slash security that a lot of people felt. I'm not
Yeah.
saying that they're not going to do well over time, and couldn't still represent what gold represents as far as sort of an alternative to currency, but they're not maybe necessarily the stablest investment right now from just a buffer to your portfolio.
Do you think it would also change how things happen going forward? Because typically, perhaps the sophistication and age of an investor in cryptocurrency might not be the person who's running to gold to create kind of that opposing force? Or do you think it might still, times never change?
No, I mean, obviously that's certainly going to be a factor, right? And I haven't seen any real studies. There's just sort of evidence that maybe the crypto is a lot younger investor than sort of typically has been gold. Also,
Yeah.
probably a little smaller investor than what's typically been gold.
Right.
But there's more of them, right? And
Yeah.
so that obviously will have a bearing. Maybe as more institutions get involved, that volatility that we've had with crypto disappears, and so it
Yeah.
does becomes that. It sort of steps in for gold, where gold used to be sort of that store of wealth stability.
Yeah.
Maybe that's where crypto becomes when there's more institutional investors. And there's obviously a lot of stuff that's going on that's bringing institutional investors into
There
cryptocurrencies. And
is.
so that will continue to advance and people
Yeah.
become more comfortable. And then, that's obviously that institutional stability.
Well, it'll be interesting to see how that goes next year. I mean, crypto is here to stay, I feel. Okay, we're going to just break down a few CSC issuer stats. It is the end of the year, so I wanted to just say congratulations to all of our issuers. We have over 700 issuers now, which is unbelievable. We have such amazing companies on our exchange. Feel so lucky, just to watch them all grow and be part of the CSC family. In 2021, our issuers, 2 point, because it's not over yet, have raised over $7 billion, 42 billion in annual trading volume, 33 billion annual value of trading, and over 12 million annual number of trades. The year's still not over, but it's been a fantastic year for us at the CSE, and definitely appreciative of all of our supporters. And just a big congrats to them. I mean, this is probably the hardest year ever to go out and raise capital, but they did it on Zoom and however they could, as safely as they could. So hopefully we have yet another great year next year. Now, going into next week. So Bruce, I'm not going to ask you about next week. I'm going to ask you, going into the end of the year, what should investors be thinking about?
Well, one thing that we always like to watch and will sometimes participate in is, the end of the year tax loss selling and the small cap effect into January. What happens is that, you have two functions. One is that you get the small caps. There tends to be a little bit more interest in small caps at the beginning of the year. People are realigning their portfolios and looking for the highest growth, which tends to come from small caps. And then this year, the small caps also tend to be the ones that have been most sold off for tax loss selling. And there always tends to be a tax loss selling bump because, the stocks that are down tend to be under more pressure as people take the advantage of the losses to offset their gains. And so those stocks tend to get pushed down this year, just based on sort of how the calendar falls. The last day for tax loss selling in Canada is the 29th and it's the 28th in the US. And so it's pretty late this year. And so you don't have a lot of days left. So you'll get a couple of days in December, and then there'll be, usually that effect for the first probably 10 days of the new year.
Great time for all of you to call your advisors and just take a look at your portfolio, see if there's anything you need to do. Put money aside, save money for a rainy day, invest. Listen, Bruce, it has been such a pleasure. I've learned so much from you this year, and I'm really excited for us to dive back into this next year. So thank you for all of your efforts. I really appreciate it.
Yeah, it's been a lot of fun. I'm glad we were able to put this together, and looking forward to next year.
Absolutely. Have a wonderful holiday.
Yeah, thanks. You too.